In November 2024, the Australian government announced a fundamental change to the Future Fund's mandate. For the first time since its creation in 2006, this sovereign wealth fund, now worth over $230 billion Australian dollars, will be directed to invest in national priorities: housing, energy transition, and infrastructure. The decision was made with little public debate. But it marks a turning point in how Australia manages its long-term wealth. This matters because the Future Fund was designed to do one thing: generate returns independent of political pressure. It was meant to cover future public sector pension liabilities, obligations that will eventually affect federal budgets, tax policy, and the superannuation system millions of Australians depend on. If the fund is now being used as a policy instrument, the question becomes: who benefits, who assumes the risk, and what happens if the returns don't materialize? In this video, we'll examine three things. First, how the Future Fund was structured, and why it worked. Second, what this policy shift actually means in financial and strategic terms. And third, what it reveals about Australia's economic position heading into 2026. Let's begin. To understand today's situation, we need to briefly go back to 2006. The Future Fund was established under the Howard government using proceeds from the privatisation of Telstra, Australia's telecommunications monopoly. The goal was explicit: accumulate capital, invest it globally, and use the returns to meet unfunded public sector pension liabilities estimated at the time to be around $140 billion. Critically, the fund was given operational independence. The government appointed a board. The board made investment decisions. Politicians stayed out. This was modeled loosely on Norway's sovereign wealth fund, which has grown to over $1.7 trillion by investing oil revenues in global equities and bonds. Australia's version was smaller, and it had no ongoing revenue stream like oil. But the principle was the same: long-term compounding, insulated from short-term political demands. And it worked. Over 18 years, the fund delivered annualized returns of around 8.4%. It grew from $60 billion at inception to more than $230 billion today. Now, in late 2024, the government has rewritten the mandate. The Future Fund will now be expected to consider investments that support housing supply, the energy transition, and economic resilience. The language is careful. The fund will still target commercial returns. But it will now have a dual mandate: financial performance and national policy alignment. This is a significant departure. I want you to look closely at this. The original structure treated the fund as a financial asset. The new structure treats it as a policy tool. On the surface, the argument is reasonable. Why shouldn't public capital support public priorities, especially in areas like affordable housing where private markets have clearly failed? But there's a trade-off. And it's one that most headlines miss. When you tie investment decisions to political objectives, you introduce two risks: lower returns and capital misallocation. Let me explain why. The Future Fund's success has been based on diversification and global exposure. As of mid-2024, roughly 60% of its portfolio was invested in equities, Australian and international. Another 20% was in private equity, infrastructure, and property. The remainder was in fixed income and alternatives. This mix allowed the fund to capture growth in global markets while hedging against domestic economic cycles. Now, if the fund is directed toward housing and energy infrastructure in Australia, it shifts from a diversified global portfolio to a more concentrated domestic one. What's unusual here is the timing. Australia is facing a housing crisis, yes, but it's also dealing with inflation, rising interest rates, and a slowing Chinese economy, which directly affects demand for Australian resources. Domestic infrastructure projects, particularly in housing and energy, tend to have longer payback periods and lower liquidity than equities. That's not inherently bad, but it does mean the fund's risk profile is changing. And here's the critical question. If returns decline even modestly, say, from 8% to 6%, does that matter? Over 20 years, on a $230 billion base, A 2 percentage point difference compounds to nearly $200 billion in foregone returns. That's money that would otherwise have been available to cover pension liabilities or budget pressures. Let's compare this to Norway, since the comparison is often made. Norway's government pension fund Global is the largest sovereign wealth fund in the world. It invests exclusively outside Norway. This is deliberate. The Norwegians understood that if you allow domestic political pressures to influence investment decisions, the fund becomes a subsidy mechanism, not a wealth generator. They also understood something deeper. Resource-rich economies are vulnerable to boom and bust cycles. If you invest domestically during a boom, you amplify the cycle. If you invest globally, you stabilize it. Australia's Future Fund was designed with a similar logic. It was meant to be counter-cyclical. By redirecting it toward domestic policy goals, Australia is doing the opposite of what Norway did. This doesn't make the decision wrong, but it does make it riskier. And it raises a broader question. Is Australia's fiscal position strong enough to absorb that risk? Let's think through what happens next. If the Future Fund begins investing heavily in housing and energy infrastructure, several things follow. First, it crowds in or crowds out private capital. If the fund is backing projects that private investors won't touch, that's a signal those projects are marginal. If it's backing projects private investors would have funded anyway, it's displacing capital that could have gone elsewhere. Second, it creates political accountability. If a housing project funded by the Future Fund fails or runs over budget, the fund's board will face scrutiny. That changes the governance dynamic. Third, it sets a precedent. If this mandate shift works politically, future governments will be tempted to expand it. Why stop at housing and energy? Why not transport, education, defense? At that point, the Future Fund becomes an extension of the federal budget, just with a longer time horizon. This is the part most headlines miss. The risk isn't just financial. It's institutional. Australia built a sovereign wealth fund that was insulated from politics. That insulation is now being weakened. Once you cross that line, it's very difficult to go back. So what does this tell us about where Australia stands in 2026? It tells us that the government believes fiscal space is tightening. If the budget were in strong shape, you wouldn't need to redirect the Future Fund. You'd issue bonds, or you'd fund housing and energy through normal appropriations. But Australia is running deficits. Public debt has risen from 20% of GDP in 2019 to over 50% today. Interest payments are growing. At the same time, the economy is slowing. Iron ore prices are down. The property market is cooling. Immigration, which drove much of the growth over the past decade, is becoming politically contentious. In that context, the Future Fund starts to look like an available source of capital. This isn't unique to Australia. Governments around the world are facing the same pressures: aging populations, rising debt, climate adaptation costs, and geopolitical instability. But the countries that navigate this well are the ones that maintain institutional discipline. Norway has done that. Singapore has done that. Australia, historically, has done that. The question now is whether that discipline is being preserved, or quietly abandoned. Let's be clear about who benefits if this works, and who pays if it doesn't. If the fund successfully invests in housing and energy, and those investments generate strong returns, then Australian taxpayers benefit. The pension liabilities get covered, and the economy gets a productivity boost. But if the returns are weak, or if projects are delayed or mismanaged, then the cost falls on future governments, which means future taxpayers. That's the nature of sovereign funds. The gains are distributed broadly. The losses are deferred. The people most at risk are younger Australians, who will inherit both the liabilities and the consequences of today's decisions. The people most insulated are current retirees, whose pensions are already locked in. This creates an intergenerational equity issue that deserves more attention than it's getting. So when you step back, three truths emerge. First, the Future Fund has been one of Australia's most successful institutions. Changing its mandate is not inherently wrong. but it is consequential. Second, the decision reflects deeper fiscal and economic pressures. Australia is not in crisis, but the margin for error is narrower than it was a decade ago. Third, this is a test of institutional resilience. If the fund can deliver both returns and policy outcomes, Australia will have found a new model. If it can't, the cost will be measured in decades, not years. Here's the question I'll leave you with. Does redirecting the future fund strengthen Australia's long-term position, or does it weaken the institutional safeguards that made the fund valuable in the first place? I'd be interested to hear your view. Thank you for watching.